Hello, and welcome to Session 4. We are going to start out with the Session 3 quiz review. And up in front of you right now, I've got the Session 3 quiz, and I've made some annotations on it so we can go ahead and review the most frequently missed questions. Let's take a look at number 1. Mr. G worked at Zippy Restaurant and received $30 in tips for 1 month. That same month, he also worked at Eater's Restaurant and earned $15 in tips. Mr. G must report his tips to both of his employers. The answer is false. Tips only need to be reported from Zippy Restaurant. Tips of less than $20 in any 1 month while working for a single employer do not need to be reported. That's a reference of Pub 17, page 54. What tips to report. Now, just because you don't have to report the tips to the employer does not mean that that $15 in tips is not taxable income. That $15 in tips would need to be reported on line 7 of the 1040. Number 2. Tip income is always includable in gross income, even if the amount received is less than $20 per month. The answer here is true. All tip income should be reported on your tax return. Pub 17, page 54, reference reporting tips on your tax return. Look at number 8. U.S. savings bond interest is taxable on A, the federal return, B, the state return, C, both federal and state returns, and D, are not taxable by federal or state. U.S. savings bond interest is taxable on A, the federal return. That is the only place that it's taxable. It's against the law to be taxed by any state. Let's move down here to the mini problem. Neelix waited tables at the Planet Earth Alliance for all of 2012. He had no other sources of income for the year. He did not keep a tip log. Planet Earth Alliance issued Neelix the following W-2. Prepare Form 4137 for Neelix and answer the following questions. Now let's take a look at the W-2. We can see that Neelix has $28,000 in wages and compensation. Of that $28,000, $18,000 of it is reported tip income. And then they've allocated $5,000 of tips to Neelix. Since he did not keep a tip log, that is why he's going to have to fill out Form 4137 and pay tip tax, Medicare and Social Security on that $5,000. If we take a look here, what is the amount to be entered on Form 4137, line 1C? Well, that is the amount of reported tips plus allocated tips. So the answer is B, $23,000. Okay, let's switch over here to the 4137 and take a look at how this all came out. So we've got the 4137. We have to put the name of the person who received the tips and their Social Security number here. On line 1, we put the employer. We put the employer identification number on it. And this is the total cash and charge tips you received, including unreported tips. So that's where we have the $18,000 plus the $5,000, and we end up with the $23,000. Column D, you put in the amount of the tips that you reported to your employer. Total everything up on column C and put it down here on line 2, $23,000 minus the $18,000 of what you reported and was also shown in box 7 of the W-2, and you end up with the $5,000 of tips that you need to report Medicare and Social Security tax on. We go through our computations here and make sure that Neelix hasn't already made and paid tax on at least $110,100 of income for the year. He certainly has not. He's got a lot of room left. He could still earn $82,100. So we go ahead and put the full amount of the $5,000 on line 10, multiply that $5,000 by 0.042. We come up with $210 here. Multiply line 6 by 0.0145. We come up with $73 on line 12. Add lines 11 and 12 together. We come up with the $283. And that amount carries to line 57 of the 1040. Now that concludes the quiz review for Session 3. You will now proceed to the lecture for Session 4, the Basic Tax Course.
We're now going to move into reporting requirements for people who have foreign accounts, but before we do that, I'm going to give you another quick poll. Qualified dividends are reported on line 9B of the Form 1040. Which of the following statements regarding qualified dividend income is not true? The first option is qualified dividends shown on line 9B are in addition to ordinary dividends. Or the qualified dividends includable on line 9B represent a portion of the dividends that are already reported on line 9A. Or to figure the amount of income tax owed on qualified dividends, you need to complete a capital gain worksheet, or qualified dividends are taxed at a maximum rate of 15%. Which of those four statements is not true? So most of you have selected the correct answer, which means you were paying attention, because I did specifically point out when I was discussing the 1099 DIV that ordinary dividends are reported in Box 1A, qualified dividends are reported in Box 1B of the 1099 DIV, and the amount in 1B is included in 1A. But the other true statement is that any amount that is qualified dividends is going to be taxed at the lower capital gain rate, and to figure the capital gain rate of tax on your qualified dividends, you do need to do a capital gain worksheet. Qualified dividends are taxed at a maximum rate for 2012 of 15%. The second, third, and fourth responses are all true. It is the first response that is false. So let's move on now to reporting requirements for foreign account holders. If you have ownership or control over a foreign financial account or trust, you may be subjected to additional reporting requirements. And these include, if you have more than $10,000 total combined money or assets in foreign financial accounts at any time during the year, the law requires you to file a report called the FBAR report using Form TD 90-22.1. That report is not a part of the federal income tax return. It has a separate filing due date, which is June 30th, and it goes to a separate processing center in Detroit, Michigan. You may also fall under the Foreign Account Tax Compliance Act, also known as FATCA. And if you meet the requirements for under FATCA, then you may be required to attach Form 8938 to your tax return. Also, if you have ownership or control over a foreign trust, you may be required to file Form 3520-A in order for the U.S. owner to satisfy its annual information reporting requirements under Section 6048B. And by the way, the IRS generally considers foreign retirement accounts to be a kind of trust. And I'm pointing this out because the IRS has really been on a mission in the last few years to enforce compliance under this FBAR report up here. If you are required to file the FBAR report and you don't, you can be subjected to pretty big fines. And if you're required to file this Form 3520-A and you don't, you can also be subjected to some pretty big penalties. And what's interesting is, although it's pretty easy to say, hey, I have a foreign brokerage account or I have a foreign bank account and clearly identify that, most taxpayers really don't think about their pension plans as being a type of financial account. And the IRS does consider a pension plan to be a form of financial account, and it does not extend the tax-free benefits to foreign pension plans that it extends to pension plans registered here in the United States. Also, if you have money invested in a Canadian retirement account or an RRSP, which is a form of Canadian account, you may be required to attach Form 8891 to your tax return. So let's talk about each of these forms briefly. This is not a class about any one of these forms. It's just a class about investment income. And if it happens to be you have a client who has financial accounts overseas, then you have additional reporting requirements. It's not enough to report the income on the tax return. There can be additional reporting requirements on top of the requirement that you report the income on the return. The first of these is the FBAR report. Title 31 for FBAR requires that U.S. persons report interests that they have in non-U.S. bank and financial accounts. Foreign financial accounts include any of the following: bank accounts such as savings accounts, checking accounts, and time deposits; securities accounts such as mutual funds and brokerage accounts, and securities, derivatives, or other financial instruments accounts; accounts where the assets are held in a commingled fund that is a mutual fund; and foreign trusts and any other accounts maintained in a foreign financial institution or with a person doing business as a foreign financial institution. And just as a reminder, the IRS generally considers foreign pension plans to be a form of grantor trust. Foreign financial accounts do not, however, include the following types of accounts: individual bonds, notes, or stock certificates held by the filer. So if you just happen to outright own stock in a foreign company, that ownership of stock in the foreign company is not reportable on FBAR, but it may be reportable under FATCA. And unsecured loans to a foreign trade or business that is not a financial institution are also not reportable under FBAR. What are the FBAR filing requirements? Well, essentially, you are required to file the FBAR report if you have $10,000 or more than $10,000 in your foreign financial accounts at any time during the year, and you are a U.S. person. And the IRS defines a U.S. person is a person who is a citizen or resident of the United States. It also has determined that a U.S. person includes an entity that was created or formed in the United States under U.S. tax laws. And entities that could be created under U.S. tax law in the United States include U.S. trusts, limited liability companies, partnerships, and corporations. So when you look at a United States person who has this interest in a foreign financial account, it doesn't just include individuals, it also includes U.S. corporations and partnerships. And if you are in the practice in your business of preparing partnership returns on 1065 or corporate tax returns on 1120 or 1120S, there is an information section on those returns where you report information to the IRS about the activities of the entity that you're preparing returns for. And one of those questions is, was there ownership in foreign financial accounts that exceeded $10,000? And if there was, you need to check the box, and then the FBAR report is required. Here is an example of a person who needs to file FBAR. If your non-U.S. financial accounts for the year 2012 totaled $11,000, you have to file Form TD 90.221 not later than June 30th, 2013. And on that report, you're going to include the name and address of the financial institution in which your money is held. You're also going to provide the account number that you have with that financial institution, and you're also going to report the high balance, the highest amount you had in that account at any time during the year. There are a few exceptions when FBAR is not required, and they include certain accounts that are jointly held by spouses. The spouse of an individual who files an FBAR is not required to file a separate FBAR if the following conditions are met, and they include that all of the financial accounts that the non-filing spouse is required to report are joint accounts that will be reported on the joint FBAR. And the filing spouse reports the jointly owned accounts on the timely filed FBAR report and then signs that report on line 44. But as soon as you have a married couple where each of them individually has their own separate accounts and also has joint accounts, then they both have to report on FBAR, and they no longer can share a single FBAR. If you are owner or a beneficiary of an IRA and that IRA has foreign investments, that IRA is not required to file FBAR. And there's a couple of other situations here listed that are not required to file FBAR. How to file FBAR? Well, on June 29, 2011, the Financial Crimes Enforcement Network, also known as FinCEN, I'm guessing that's how they pronounced it, announced that all FinCEN forms must be filed electronically with certain exceptions. So it appears to be the case that we're moving to a point where we will have to file FBAR electronically, but certainly for 2012 filings of FBAR that are due June 30th of 2013, they can still be filed paper. And if you file those paper, you're supposed to mail them to the Department of Treasury in Detroit, Michigan. It's also possible to hand carry them into the local office of the Internal Revenue Service for forwarding to Detroit, Michigan. There is no extension of time to file the FBAR report. If you file it late, you need to attach a statement explaining why it's late. And there are some significant penalties here. If you file FBAR late or not at all, you may be subjected to some pretty serious penalties. There's a negligent violation of $500. There's a non-willful violation of $10,000. There's a pattern of negligent activity where probably you knew you should be doing it and just haven't bothered, and that's $50,000. There's also willful failure to file. In other words, you knew you were supposed to and you willfully decided not to, and that can be the greater of $100,000 or 50% of the amount you have in the account. Well, let's just think about what the purpose of these laws is. The IRS and our federal government have basically made it their mission to find rich tax cheats hiding their money overseas in undisclosed foreign financial accounts, kind of the old Swiss or Cayman Island accounts. Hide the money there, and then they don't disclose it, don't pay tax on it, and Uncle Sam doesn't know. Well, Uncle Sam has pretty much made its mission to zero in on these countries where money is being harbored and essentially is threatening sanctions against these countries if they don't begin to reveal Americans who have money in these foreign accounts. And let's just suppose you're an American with $500 million in a Swiss bank account that you've never reported. Well, why wouldn't you report it? One reason you wouldn't report it is you don't want to pay tax on it. The other is maybe it's illegally obtained money. Maybe you're a drug baron and you're making the money and you're hiding it there. In either of those situations, the IRS is going to be looking for you, and if they determine that you have $500 million overseas that you've never reported, potentially you could be subject to a $250 million fine. You could also have an additional $250,000 fine and be subjected to 5 years imprisonment. Down here it moves up to 10 years imprisonment and a $500,000 fine, as well as 50% of the money on balance. So not filing FBAR is a crime, and you are required to file it. So as tax practitioners, we should be on top of those rules. If you have any questions about FBAR, I have a link in the manual that you can click on to go and learn more. Here is page 1 of the FBAR report, and you can see that it provides an indicator checkbox for who is filing the report. Down here, for a separate owner, it asks for the maximum value in the account during the year, the type of account that you had, the name of the financial institution, the account number of the financial institution, the address of the financial institution, and then a place for the filer to sign. All of the other supplementary pages to the FBAR report are used for reporting additional accounts. We're going to move on now with a discussion of Form 8938, and this form came into being for the first time for the tax year 2011. It's referred to as the FATCA form. It is used to acknowledge or specify the types of foreign accounts that you have, but the form itself is only required if the value of your foreign accounts is pretty high. With the FBAR report, if your financial accounts exceed $10,000 during the year, then that particular form is required. But the FATCA form is only required when the value of your assets exceeds $50,000, and on a joint return, it's when they exceed $100,000 at the end of the year. And if you reside overseas, it can be even 4 times that amount before the form is required. But unlike the FBAR form, Form 8938 is actually attached to the federal return, and it is used to report the existence of the foreign financial accounts, the range or amount of money you have in the foreign financial accounts, and to acknowledge that the money, if any of it is generated income, that income has been reported on the federal tax return. So this is the reporting requirements for the FATCA Form 8938, and you have to look to your filing status and whether or not you are residing inside of the United States or whether you are living abroad. If you are unmarried, living in the United States, and the value of your account on the last day of the year was $50,000 or more, then you need to attach the form. But if you're residing overseas, then the account value has to be over $200,000 before you're required to file. But even if on the last day of the year it's worth less than $50,000, if the account at any time during the year was $75,000 or higher, or the value of your foreign financial accounts was $75,000 at any time during the year, then the form is still required. For married filing joint, you take those figures and essentially double them. The IRS does have a specific definition of who is considered to be living abroad. Happens to be that this definition fairly much is identical to the person who can qualify to claim the foreign earned income exclusion on 2555. IRS says you are considered to be living abroad if your tax home is in a foreign country and you are either a bona fide resident of the foreign country for an uninterrupted period that includes an entire tax year, or you are a U.S. citizen or resident who during the period of 12 consecutive months ending during the tax year is physically present in the foreign country for at least 330 days. If you are not required to file a tax return for the year, then you do not have to file 8938 even if the form would otherwise be required. Now with FBAR, all different types of U.S. entities are required to file the FBAR report, but currently only human beings, individuals, are required to file Form 8938, but the IRS does expect at some point in the future to announce procedures where other types of U.S. entities will also be required to file this form. Now the form itself is laid out a little bit differently than FBAR, or quite a bit differently than FBAR actually. It's asking you to identify the type of individual you are, and we actually do have domestic entities with checkboxes on them this year. Then we have the foreign deposit and custodial accounts. Basically these are bank accounts that would be reported in Part 1. In Part 2, this is where you would enter information on other types of foreign assets, and it continues on to the next page. And then at the bottom of page 2, in Part 3, space is provided where you are to enter the income that came from your foreign financial accounts and where on your tax return you reported that income. So if you have a foreign bank account with $100,000 in it, then you would be required to file this FATCA form, and it's likely that that bank account generated interest income for you. And if it did, then the IRS wants to know how much interest income came from that account and where on your tax return you have reported that income. Down at the bottom in Part 4, it says that if you reported specified foreign financial assets in the following forms, check the appropriate box or boxes, indicate the number of forms that were filed, but you do not need to include these assets on Form 8938 for that year. So if you have foreign financial assets that are required to be reported on one of these other forms, you of course file the other form, and then on the Form 8938 you would indicate which of the forms you filed, the number of forms that you filed, and that would explain why you've not included those on the 8938 form. Now, do you think there might be a few people in the world who are supposed to have been reporting their foreign financial accounts and haven't been doing it? There's probably a lot of them, and a lot of them may not even know that they're required. In other words, they should have been filing them and reporting them, but they haven't, and the reason that they haven't been doing it is they simply did not know that they were required to. But in other situations, there could have been a deliberate effort or decision made not to report them. And since the IRS, in conjunction with the Foreign Financial Crimes Division of the Justice Department, have been working in cooperation to track down these people, in an effort to bring people back into the system voluntarily, a couple of initiatives were presented beginning in 2009 and again in 2011. And people who have these foreign accounts and have not disclosed them were invited to voluntarily come forth and disclose them. And if they did so, then they would get reduced penalties and avoid possible prison terms. If you have clients that fall into those categories and they decide that they want to do that, instead of paying the normal 50% penalty, they might only have to pay 27.5% of a penalty. Or if the account does not surpass $75,000 in value, they might qualify for a lower 5% or 12.5% penalty. If you want to know more information about those voluntary measures, there's a link here where you can go to learn more. Now, it happens to be the case that especially in 2011, the IRS was doing a lot of outreach and was actually running commercials on foreign television stations, at least in Canada, but also probably in the press. There was information coming about these voluntary disclosures. My office here in Portland, Oregon, I started to get phone calls from a number of Canadians. It might be because I am Canadian and I have connections up in Canada, but at any rate, there was a period of time there where I was getting a lot of phone calls from people living in Canada who had recently discovered that they should have been filing the FBAR report and that they were supposed to be filing U.S. tax returns, in some cases for many, many years, but that they didn't know that they were supposed to and that they hadn't, and they were very worried about what to do. There was no provision at that point in time, basically 2011, for people in that situation. So most of them just decided to put their head in the sand and do nothing because they didn't want to come forward and voluntarily pay huge amounts of money to the government of the United States when they had really no connection to the United States other than a citizenship that they hadn't been acting on for many, many years. And so as a result of that, in September 2012, the IRS did announce a new streamlined procedure for bringing non-compliant foreign residents into U.S. tax compliance. And these are people who are basically either citizens of the United States or residents of the United States living outside of the United States who haven't been meeting their filing obligations. The IRS now has streamlined procedures in place for those individuals. They include filing delinquent tax returns with the appropriate related information returns for the past 3 years and filing delinquent FBAR reports for the last 6 years. Each submission is looked at on its own weight, but if the amount of tax owed is $1,500 or less, they're considered to be a low compliance risk and will face little penalty, if any. If you're interested in those measures or those procedures, here is the URL that you can click on in the manual to get to more information that IRS has on those. Now, as a part of all of this effort to bring people with foreign accounts into compliance, the IRS considers foreign retirement accounts to be a foreign financial asset. It also does not consider these foreign financial assets to be tax exempt or tax deferred the way U.S. pension plans are. And if you have money in a foreign retirement account, odds are that it's earning income and you are required to report it on your tax return, probably in more than one way. And if you have a foreign retirement account or a foreign trust, it's probable that you are likely required to at some point file Form 3520, the annual return to report transactions with foreign trusts and to also report the receipt of certain foreign gifts, and Form 3520A, the annual information return of foreign trust with a U.S. owner, or in the case of people with Canadian accounts, Form 8891 U.S. information return for beneficiaries of certain Canadian registered retirement plans. There is no way I can go into a detailed discussion on these returns. The first is that the tax law on them is horribly brief. IRS offers almost no guidance. I literally spent days on the phone with IRS talking through my congressman's office, the taxpayer advocate office, the tax practitioner liaison office with IRS to essentially get told that the only place to go for more information on Form 3520 and 3520A is my tax practitioner, and that's who I am already. So there's not much guidance out there. You're going to be left on your own. If you think you have a client who is required to file these forms, you're basically going to have to figure it out on your own. But Form 3520 is used to report the following activities: the creation of a foreign trust, including a foreign retirement account, contributions of money to a foreign trust, withdrawals or distributions from a foreign trust, and the receipt of foreign gifts. So if you believe you have a client that falls into any of those categories, then you're on your own. You're going to have to research it, figure out, and stumble your way through it. Form 3520A is used to report the following information on an annual basis: general information about who owns and controls the trust, an income statement for the trust, a balance sheet for the trust, and a beneficiary statement for the trust. And by the way, if you're required to file the 3520A and fail to do so, there is an initial penalty equal to the greater of $10,000 or 5% of the gross value of the trust assets during the year. The penalty also applies if you do not furnish all of the required information on the form. And I can tell you right now that my clients found it incredibly difficult to get information from their foreign retirement accounts about income generated in those accounts and the type of income that was in them. It was just almost impossible to get it, and the IRS doesn't seem to care. They say a penalty can apply anyway. The next form we're going to talk about is 8891. This is the form that is used by U.S. citizens and residents to report information that they have if they have ownership of Canadian retirement accounts. These accounts are referred to as registered retirement savings plans in Canada or registered retirement income funds from Canada. So if you have either of those types of accounts in Canada, the form may be required. Here is Form 3520. 3520 is a 6-page form that is used by U.S. persons to report certain transactions with foreign trusts, the ownership of foreign trusts, and receipt of certain large gifts or bequests from certain foreign persons. 3520 is the annual information return filed for these trusts, and it is also a multi-page form. I'm just showing you page 1 of it. And then we have the 8891 form that is completed and attached to the 1040. The 3520 forms are separate returns that are filed at separate addresses. They are not attached to the 1040, but 8891 is a form that is attached to the 1040. if you are required to file it, you need to complete it. This form is also used to make an election to have your Canadian retirement account treated as if it was an American account. In other words, to get the tax-deferred status on it and not have to pay or report income that is being generated inside your Canadian retirement account. Most foreign countries do not receive this special tax treaty benefit that Canadians have. I believe there's some provision under United Kingdom laws with the United States that you could get tax-deferred treatment with your United Kingdom pension plans, but outside of the UK and Canada, I'm not aware of any countries that have similar tax treatment available. So that concludes my discussion today on investment income. We're now going to spend the last of today's class talking about other types of income that is reportable on your U.S. tax return. And we're going to begin with other income, taxable refunds. And of course, taxable refunds are reported on line 10 of the Form 1040. But the thing to remember when you receive a refund from the state is that the tax refund you receive from the state is only taxable and is only reportable on your U.S. tax return if you received a benefit by deducting it in the first place. Now, most of the time, a 1099-G is issued only when the state determines that you itemized your deductions in the earlier year. So it determines that you filed a Schedule A, and because you filed a Schedule A, you took a deduction for state income tax, and since you took a deduction for state income tax, that refund must be taxable. But the number that appears on the 1099-G may or may not be taxable, or it may be partially taxable. So as a tax practitioner, it's your job to determine whether or not the income reported on the 1099-G is in fact taxable, and it's taxable only if there was a tax benefit. Now, what about the federal tax refund? Is that taxable? Well, the federal government never allows you deduction for federal taxes, and therefore a refund of federal taxes is never taxable on the federal return. In most cases, it's also not taxable on the state return. However, in certain situations, a federal refund may be taxable at the state level. We do discuss the taxation of federal refunds in two different state law courses that we teach on Oregon and California law. So if you're a resident of Oregon or a resident of California and you want to take a course from us on state tax law, we do discuss the taxability of federal refunds at the state level in our courses specific to those states, but we don't offer state law courses on any other states at this point. So let's move on now with the taxability of a state refund. Again, you have to have received a tax benefit, and the IRS does provide a worksheet that you can use to determine whether or not you had a benefit. I think the better way is to flip back to the last year's tax return that was filed where that state tax was deducted and say, all right, well, if they hadn't claimed a deduction on Schedule A for state tax, would their refund or their tax situation have changed? And if the answer is yes, not claiming state taxes as a deduction would have increased their tax in the earlier year, then the refund's taxable this year. But if I look at the earlier year and I see that their tax liability for the year was zero, they itemized their deductions and claimed $5,000 of state income tax as a deduction, but even if they hadn't claimed it as a deduction, their tax still would have been zero, then it's not taxable. So the worksheet sort of guides you through those steps, but I find it to be incomplete and not accounting for every variable. So I prefer to actually just go look at the earlier year's return. Now, there are other types of refunds besides state tax refunds that can also be taxable, and one of those is a recovery of mortgage interest or other deductible expenses. As with your state tax refund, you should claim a refund of expenses as income if you previously derived a tax benefit by claiming that expense as a deduction on your tax return in the earlier year. And here we have an example. If you claim mortgage interest you paid as an itemized deduction on Schedule A, and in a later year you receive a refund from your mortgage company for the overpayment of interest, you must include the refund of interest as income on your tax return, and you should treat that refund of interest in the same way you treat all other taxable interest income. Now, here's one of the bad deals. If you claim a deduction for mortgage interest or income taxes on your tax return, you claim those on Schedule A, don't you? That means you're giving up the standard deduction and you have to deduct them on Schedule A. But if any of those get refunded, they go back into regular income. You don't take them as a reduction to your itemized deductions, which would seem fair. Rather, you have to throw them into income, and because you're throwing them into income, they increase your income, and they may cause you to phase out on certain tax benefits that have phase-outs based on income. So the IRS definitely gets one up on the taxpayer with the treatment there. The next line that we're going to talk about is unemployment compensation. And when you're looking at the 1040 form, unemployment compensation is included on line 19. Unemployment compensation, if you received it during the year, will come on a 1099-G form, which is issued by state governments. And the 1099-G form is also used to report state tax refunds that were issued by the state. So you would never see, at least I've never seen, a 1099-G that had both unemployment and state tax refunds reported on it. Typically they'll issue one 1099-G for the state refund and another 1099-G if you received unemployment. But just to save space, I've put both amounts on the same 1099 just for purposes of this illustration. And you can see that unemployment benefits of $3,500 were reported in box 1. Those will carry down and get entered on line 19 of the 1040. A state taxable refund of $1,800 was paid out during the year, and that is reportable on line 10. Now, in certain situations, it may be the case that you received unemployment benefits during the year, but then you repaid part of those benefits. Or it could be a year where you paid more unemployment back or repaid more unemployment than you received. IRS says if you receive unemployment benefits during the year and also repaid unemployment benefits during the year, you would enter repaid on the dotted line and reduce the amount reported on line 19 by the amount you repaid. So if you received $3,500 of unemployment during the year, but you had to repay $2,000, you would enter repaid $2,000 on line 19 on the dotted line, and then on the space where you enter the income, you would enter $1,500 instead of $3,500. And the next topic we're looking at in line is alimony. It is also called spousal support. Every year I tell the same story because it amazed me so much I always come back to it. For about a decade I prepared taxes for a woman who was divorced. Every year I asked her the same question, did you receive any alimony? And her answer was always the same. And then one year she said to me, is spousal support taxable? Well, obviously she had not thought that spousal support was alimony. And in fact, spousal support is another word for alimony, and so ultimately we had to go back and amend prior year returns so that she could report her alimony and pay tax on it. So sometimes no matter what we do as a tax practitioner, no matter how hard we try to communicate the need to get information, our clients are not understanding us. So from that point forward in time, I've always asked clients, did you receive alimony or spousal support during the year? One of the things that does go on with IRS is that it spends a great deal of time trying to specifically identify when you have a situation that there is alimony and when you do not have alimony. And as a tax practitioner, you're expected to know when payment is alimony and when it is not. You'd be surprised how often I have clients ask me, well, I got this money from my ex-spouse, or I got this money in the divorce. Is it taxable as alimony or not? Or the converse might be, I had to pay my ex-spouse all this money when we divorced. Is that something I can deduct? So as a practitioner, the information I'm providing you today will help you to determine whether or not the income is something that is either deductible or reportable. IRS says that to be alimony, all of the following must be true about the payment. The payment must be required by a divorce or separation instrument. You cannot file a joint return with the spouse who paid you the alimony. The payment must be in cash or by check, which is essentially the same as cash. Your divorce or separation maintenance decree must not state that the payment being made is not alimony. You and your former spouse who is paying the alimony cannot live together. There is no liability to make any payment in the form of cash or property after the death of the recipient spouse, and the payment is not treated as child support. Also, you cannot report alimony you receive on Form 1040-EZ or 1040-A. It is a long form item, and you have to file a long form if you are dealing with either the income part or the deduction part of alimony. Child support is important. If your divorce or separation instrument specifically designates that a payment is child support or treats the payment as child support, then the payment is not alimony. A payment is specifically designated as child support to the extent that the payment is reduced either by the happening of a contingency relating to your child, such as the child becomes employed, or dies, or leaves school, or leaves the household, or marries or reaches a specified age or income level, or at a time that can clearly be associated with a contingency. So if any form of payment being made subject to a divorce is contingent on any event surrounding the child, then the law says it's not alimony, it is child support instead. Here is an example of a payment that is alimony. Steve and Sandra Ballard are divorced. Sandra has custody of their 2 children. The divorce decree states that Steve shall pay Sandra $1,500 per month. The decree does not stipulate that any of the payment is contingent on either of the children. Therefore, the entire payment is considered to be alimony. Here's another example where the payment is partially alimony and partially child support. Jean's divorce decree states that her former husband, Harry, must pay her the following monthly amounts: $600 of spousal support and $200 of child support for each of their 2 children. Harry made all required payment for the year. Jean will report $7,200 of spousal support as alimony on her tax return, and Harry will be allowed to claim $7,200 of alimony that he pays her as an adjustment to income on his return. But the $4,800 of child support that Jean receives from Harry is not taxable to her, nor is it deductible by Harry. Now, lots of people who pay child support feel that that's just not just. They've had to pay all this money in child support, and why can't they deduct it? Well, the answer is you're not allowed to claim a deduction for how much money it costs you to support your children. The only deduction you're allowed to ever claim in relation to children is their exemption deduction, or if they qualify for the child tax credit, the child tax credit. You know, there's other deductions out there as well, or credits out there like the earned income credit, head of household filing status, the child independent care credit. But to outright just claim a deduction on your return because you had to support your children, that doesn't exist. And that's why child support is not deductible. Now, there's another rule you have to remember here, and that is that child support is always paid before alimony. If a divorce instrument orders payment of alimony and child support, the child support shall always be considered paid first. The total child support and alimony payments for the year are less than the amount stipulated in the divorce decree. All payments shall be considered to have been paid towards child support first, and any remaining amounts shall be applied to alimony. And that comes directly out of IRS Publication 504 on page 13. Here is an example of that rule. John and Jane are divorced. The divorce decree states that John must pay Jane $13,200 each year based on the following monthly amounts: $600 of alimony each month, and $500 of child support each month. During the year, John fell behind on his payments. His payments to Jane for the year totaled only $8,000 instead of the required $13,200. The result of that is that only $2,000 of alimony is considered to have been paid. Jane will report $2,000 of alimony on her return, and John will be able to deduct $2,000 of alimony as money that went out. This looks like a good time to challenge your minds with another poll. Laura's divorce decree states that her ex-husband will pay her $2,000 per month until the earlier of the date that their son James turns age 24 or graduates from college, after which the payments shall be reduced to $1,000 per month. Laura received $24,000 of payments during the year. How much alimony should she report on her tax return? We've got $2,000 a month that's being paid out in alimony. It's going to stay at $2,000 a month until James turns 24 or graduates from college, at which point it's going to drop to $1,000 a month. The money that's coming in is going to go down on a date that has a contingency related to the child. It's a date associated with the child. And therefore, to the extent that the payment is tied to that child, that tied payment is child support and not alimony. If Laura receives only $12,000 for the year, she has not received any alimony. So the alimony payment that she reports will be zero. So $24,000 is required during the year. Only $12,000 of payment was made. The $12,000 of payment that is made goes to child support first. It means she received no alimony, and the amount of income that she is going to report on her return from alimony is zero. All $12,000 of payment that she received during the year is tied to the child. It's a contingency around the child, and therefore it is non-taxable child support to her. Moving on, alimony requirements. This is a table that comes out of IRS publications on the definition of alimony. It's just a summary. IRS says payments are alimony if all of the following are true. The payments are required by a divorce or separation instrument. The payer and the recipient spouse do not file a joint return together. The payment is in cash, including checks or money orders. The payment is not designated in the instrument as not alimony. The spouses legally separated under a decree of divorce or separate maintenance are not members of the same household. The payments are not required after the death of the recipient spouse. The payment is not treated as child support. All of the payments described in this first left-hand column are deductible by the payer and includable as income by the recipient. But IRS says payments are not alimony if any of the following in this column are true. The payments are not required by the divorce or separation instrument. The payer and the recipient spouse file a joint return together. Or the payment is not in cash, is a non-cash property settlement, is for the spouse's part of community income, or to keep up the payer's property. The payment is designated in the instrument as not alimony. The spouses legally separated under a decree of divorce or separate maintenance live together in the same household. The payments are required after the death of the recipient spouse, or the payment is treated as child support. If any of the conditions in the right-hand column are met, then the payments are not deductible by the payer, nor are they includable as income by the recipient. Now there's one more question I'm going to ask you with regards to alimony. It's the final question I'll give you for today. This one's a little bit tricky because I haven't really covered it in the lecture, but it's actually something that can come up quite often. Read it with me and then think about it. Under the terms of their divorce decree, Trevor must make the full mortgage payment on a home that is jointly owned by himself and his ex-wife, Tiffany. Total payments for the year on the home totaled $25,000. Then Trevor received a 1098 mortgage statement from the mortgage holder showing that $15,000 of mortgage interest and $5,000 of real estate taxes and $1,000 of insurance had been paid on the home for the year. What is the proper way for Tiffany to report these items on her return? The correct answer is actually C. Even though the IRS says that payments must be in the form of cash to be considered alimony, the IRS does state that if you make payments on a home that is owned in full or partially owned by your ex-spouse, the payments that you make on that mortgage are for property that is owned by your spouse and in effect become an alimony payment to that ex-spouse. So in Tiffany's case, she's living in a house that's jointly owned by herself and her ex-husband. He is making full payment on that mortgage, but he's a joint owner on that mortgage. And so in effect, 50% of the payment he makes on that mortgage is towards his own property. 50% of the payment he makes on that mortgage is for Tiffany's property. And therefore, half of the $25,000 of payment for the year is going to be alimony payment coming out from Trevor and going to Tiffany. So Tiffany's going to have to report $12,500 as alimony payment received on her tax return. But in turn, that mortgage has been paid on her behalf through an alimony payment that is taxable to her, and she will be allowed to deduct on Schedule A her half of the mortgage interest and real estate taxes. That is why C is the correct answer. So go on your own and read the IRS publication to get the full picture and additional illustrations. Password number 1 is now showing on the screen in front of you. Password number 1 is TRILL, T-R-I-L-L. Please write it down. Please write down T-R-I-L-L, TRILL, as password number 1. Gambling winnings. Gambling winnings are taxable. The IRS says any gambling winnings you receive for the year need to be reported on your tax return. And you will be issued a Form W-2G if you receive any of the following: $1,200 or more in gambling winnings from bingo or slot machines, $1,500 or more in proceeds from Keno, more than $5,000 in winnings from a poker tournament, $600 or more in gambling winnings, and the payout is at least 300 times the amount of the wager, and any other gambling winnings subject to federal income tax withholding. So I don't see a whole lot of W-2Gs in any one year, but I do see a few. And typically tax software does have an entry field where you can enter the gambling winnings. Gambling winnings are reported on line 21 of the tax return. If you have any gambling losses are deductible to the extent of gambling winnings on Schedule A, and gambling losses claimed on Schedule A are not subject to the 2% limit. Reporting K-1 income, we're down to line 17 of the Form 1040 now. If you receive a K-1, you are required to report the income flowing through to you from that K-1 onto your tax return. And earlier on, I showed you a K-1 at the back of the manual under our classwork assignment. I'm just going to flip to that again. And this particular K-1 is actually our classwork assignment for the day. I will go over the classwork assignment at the end of class. If you want to stay to review the classwork assignment with me, if we run over, you can stay late. If you don't want to stick around for the classwork assignment answer key, you can just check out when the lecture ends. But this is part of the classwork assignment that we're going to be working on today, where we have a K-1 issued from Gridirons Inc. to a character named Jerry McGuire. And he has received a K-1 reporting ordinary business income of $1,600, interest income of $1,000. He also has a Section 179 deduction flowing through to him on line 11, and line 17 is showing other information, $1,000, and it's essentially Code A is telling you that that is investment income to Jerry. Jerry's responsibility, and your responsibility as his tax preparer, is to make sure that the income from this K-1 flows through to his personal return and is reported correctly. And the way that you would report that income is to look to the character of the income being reported and make sure that it gets reported on the correct line of his tax return. Now, if you have business income reported on a Schedule K or rental income being reported on a Schedule K-1, those will carry through to line 17 of the Form 1040. But most other types of income flow through to other lines of the 1040. So how do you fill out a K-1, or how do you prepare a K-1? What are the rules behind preparation of a K-1? We actually discuss those much later on in our series. I believe in July I'm offering a couple of classes called Introduction to S Corporations and Limited Liability Companies. And in those classes we'll look at the preparation of a partnership return, we'll look at preparation of an S Corporation return, and how you complete and enter numbers on the K-1. As a tax practitioner, when you receive a K-1, your customer brings you a K-1 and asks you to prepare their tax return, you really have no way of knowing that the K-1 is prepared correctly. You essentially have to rely on it and essentially treat it like you would treat a W-2. It's got income that's been reported on that. You needed to carry that through and enter it properly on the tax return. When you have positive numbers or positive income figures appearing on a K-1, those are pretty easy to establish that they're taxable and they need to flow through. But when you have a negative number on a K-1 representing a loss, there's additional rules that you have to be aware of, in that that loss may or may not be allowed on the shareholder or partner's tax return. And the shareholder or partner will only be allowed to claim a loss if they meet certain tests, including the at-risk limits and the passive activity limits. And we talk about those limits in our course called Passive Activity Loss Income and Rental Income. And that comes a little bit later in our series, probably sometime in June before we get to that. But when we get onto that topic, we cover some very important items, which are when are losses allowed on the 1040 return of a person who receives a K-1. Those losses are allowed if they meet the passive activity limit rules and they meet the at-risk limit rules, both of which are beyond the scope of today's class. For today's class, with regards to K-1s, we're only looking at how treatment is given to income that flows from a K-1 onto the personal return, and we'll take a look at a specific illustration with our classwork assignment for Jerry McGuire at the end of today's class. Estates and trusts also issue K-1s, but not all estates and trusts will issue K-1s. A K-1 is only issued by an estate or trust when there has been a determination that money distributed from the trust is taxable income to that beneficiary, or if there is a requirement on the part of the trust in the trust document that income made by the trust is taxable to the beneficiaries. So lots of trusts issue K-1s, but lots of trusts also do not issue K-1s. But when a K-1 is issued, you do need to deal with the flow-through. Now, as often as not, a trust or an estate K-1 may be flowing through deductible items for the Schedule A. So estate and trust documents often have a very different look to the K-1 than the partnership S Corporation ones do. Canceled debt is the next topic of the day. If you borrowed money and the debt was canceled, you must generally report the amount of canceled debt as income on your tax return. IRS Publication 4681 called Canceled Debts, Foreclosures, Repossessions, and Abandonments is a good place to go to get more information about the type of income that is a canceled debt and is taxable as canceled debt, but also to learn about when canceled debt is non-taxable. If you determine that you have canceled debt that may not be taxable, you're going to have to ask for tax-free treatment from the IRS, and you do that by filing a specific form to request that tax-free treatment. If you receive a 1099-C, it means you have received canceled debt. The IRS is going to be looking for that income to be reported on your tax return, or as an alternative, you claim an exclusion to reporting the income on your return. But you don't just ignore it. If your client gives you a 1099-C or a 1099-A, odds are that you're going to have to do something with that income on the tax return. And it's your job to determine whether or not the canceled debt is taxable. Now, one of the most common types of canceled debt that we've seen in our last recession, the Great Recession, was cancellation of debt on a principal residence. And beginning in 2007, there were so many people that were beginning to default on mortgages under great hardship that the Mortgage Forgiveness Debt Relief Act of 2007 was passed. And it was originally meant to apply to debt discharged after 2006 but before 2010. And each and every year since then it's been extended so that we are now still able to exclude canceled debt on a home up through the end of this year, 2013. There are rules about what kind of mortgage debt can be excluded from income, and they are summarized here. The maximum amount you can treat as qualified principal residence indebtedness is $2 million, half that amount if you are filing separately. Additionally, the basis in the principal residence must be reduced, but not below zero, by the amount of debt that was excluded from gross income. And to claim the exclusion, you have to file a specific form, which is Form 982, Reduction of Tax Attributes Due to Discharge of Indebtedness. And you have to attach that to your tax return. So what is qualified principal residence indebtedness? Well, to be qualified, the mortgage you take out must have been used to buy, build, or substantially improve your principal residence, and it must be secured by your principal residence. The following types of debt secured by your principal residence are also considered to be qualifying debt. A refinance of qualified principal residence indebtedness is treated as qualified principal residence indebtedness, but only up to the amount of the old mortgage just before the refinancing. So let's just suppose you have a home and you owe $200,000 on it, but it's worth $400,000. So you refinance it and you take out a $300,000 loan on the refinance. Well, the first $200,000 is going to be home acquisition indebtedness, and the final $100,000 has nothing to do with home acquisition. You've got $100,000 there. It's home equity debt. Interest you pay on it is deductible, but if you get that debt discharged, it may not be excludable. So the IRS looks at how much debt is being discharged, and you're only allowed to exclude from income discharged debt up to the amount of original home acquisition debt. Now, if you use that home equity debt to make improvements to your home, then it would qualify as well. And let's look at an example of a discharge of a non-qualified debt. Your principal residence is secured by a debt of $1 million, of which $800,000 is qualified principal residence indebtedness. Your residence sells in a short sale for $700,000, and $300,000 of debt is discharged. Only $100,000 of the debt discharged can be excluded from income because the remaining $200,000 is non-qualified debt. Here is illustrations of both 1099-A and 1099-C. Typically when my clients come in with these forms, they are formatted and look exactly like this. Your client has either of these forms, you're going to need to take action on the tax return, and that typically means either the income reported on them is taxable or it's not taxable. But if it's not taxable, you have to attach Form 982. Now, 982 is used for more than just discharge of qualified principal residence indebtedness. It is also used when you are able to exclude discharged debt for other reasons. And long before we had the Mortgage Forgiveness Relief Act of 2007, we had other reasons for the existence of Form 982 and other reasons why discharged debt could be treated as non-taxable. Those other reasons include things like bankruptcy, insolvency, certain farm debts, non-recourse loans, gifts, and qualified real property debt. I would say the most common among these that I have run into with my clients over time is bankruptcy and insolvency. If you have debt discharged as a part of going bankrupt, then none of the discharged debt is taxable, and you just need to know that. So one of the first questions I have of a client when they bring me a 1099-C or a 1099-A is, did you file bankruptcy? And is this associated with the filing of your bankruptcy? Because if it is, it's not taxable. But if they didn't file bankruptcy and it was not a discharge of debt on their principal residence, then odds are it is taxable unless they meet the exception for being insolvent. And I first learned about insolvency rules and the exclusion of canceled debt from income back at an IRS seminar I attended in Anaheim back in 1997. So this is definitely not new stuff. It's not new to my thinking parameters as a tax preparer. I've always asked the question about insolvency when my clients have canceled debt. And when the IRS looks at canceled debt, they're actually looking at the quick sale value of all of your assets and what your assets would sell for essentially at auction. If you held an auction or a garage sale and had sold everything you owned in the world at one time in one day as quickly as you could, what would you get? And IRS says that's what your assets are worth. Then you look over at the debt side of things, and on the date that that debt was canceled, did you have more debt on the books than you had assets on the book under the quick sale method? And if your debt is more than your assets, then you are allowed to exclude from income canceled debt to the extent of insolvency. So if we just kind of do a quick illustration in our minds, let's suppose I have credit card and car loan debt totaling $100,000. And if I add up all the assets I have in the world, including my pension account, all of my assets in the world are worth $80,000. Well, I am insolvent to the tune of $20,000. And if my credit card company discharges me of $30,000 of credit card debt, I'm going to be able to exclude $20,000 of credit card debt because that's the extent to which I am insolvent. And only $10,000 of credit card debt would be taxable. But to determine whether or not you have insolvency, the IRS does have worksheets for that. So you need to go through and read the instructions for Form 982, the corresponding publications, and really do a careful job of determining whether or not your client meets the rules for insolvency. The next page of the manual, I do have a Form 982. I haven't filled it out. I haven't really provided you with an illustration either. I just wanted to show the form to you. It's a rather intimidating form in the number of lines it has, and when you read the lines, the descriptions for each line are kind of confusing. What do they really mean? Well, since most of the debt that we see that's being discharged these days is to do with qualified principal residence indebtedness, I figured I'd point out what's important on the form with regards to that. Firstly, on Part 1 of the form, you would go to line 1E and check the box next to line 1E. It says discharge of qualified principal residence indebtedness. That means you're filing Form 982 because of a discharge of debt related to your home. You then go over to line 2 and you enter the total amount of discharged indebtedness that you are excluding from your income. If you have $100,000 of discharged debt that you are excluding from your income, and it's all home acquisition debt or home improvement debt, then you would enter all $100,000 on line 2. And then on line 10B, if you continue to own the residence after the discharge, then you will enter the smaller of the amount of principal residence indebtedness included on line 2, or the basis in your home, which is generally your cost plus improvements. But if the home was just sold on a short sale and you're no longer the owner of it, you leave line 10B blank. 10B only has a number on it when debt is discharged on your home, but you continue to own it. And I have actually seen that happen. Password number 2 is MULE, M-U-L-E, MULE. The final topic of the day is foreign earned income exclusion. If you are a U.S. citizen or a resident alien, your worldwide income is generally subject to the same tax laws as if you were still living in the United States. The fact that you moved away from the United States and may not have lived here for decades does not affect your filing requirement. Your filing requirement as a U.S. citizen or resident is the same no matter where you live in the world, in other words. And your filing requirement is essentially based on your age, your filing status, and your income. And we spent quite a bit of time talking about filing requirements in the last class we held, which was called Filing Requirements, Filing Status, and Dependents. So if you meet filing requirements based on your age, income, and filing status, you are required to file a U.S. tax return. But understandably, it may not seem entirely fair that if you are residing outside of the United States, that you would be required to pay tax to the United States on all of your income, especially if the foreign country is also taxing that income. So for that reason, the IRS has two separate tax benefits available to U.S. citizens residing overseas. One of those is the foreign earned income exclusion, and the other is the foreign tax credit. I'm talking about the foreign earned income exclusion here in today's class because the foreign earned income exclusion is actually entered as a negative number on line 21. And since today's lecture is about other income, including income reported on line 21, I thought I would give you an illustration of where you would actually enter a negative number on line 21. But also, the foreign earned income exclusion is tied to the foreign wage income, and in certain situations, foreign self-employment income, and we spent quite a bit of time today talking about wage income. So if you are a U.S. citizen or resident alien living overseas, and you have wage income that you earned overseas or self-employment income that you earned overseas, you will need to report that income on your tax return. But if you meet certain rules, you will also be able to exclude some or all of that income from being actually taxed on your U.S. tax return. Now, there are a lot of rules that you should know about if you are dealing with a United States person living overseas, and a lot of those rules are described in Publication 54 and also in Publication 519 if you're dealing with expatriates. But let's look at the rules for the foreign earned income exclusion. If you worked and lived outside of the United States for a minimum of 330 full days during a period of 12 consecutive months, or you were a bona fide resident of a foreign country for at least a full tax year, you may be able to exclude up to $95,100 of your foreign earnings. In fact, you may be able to exclude more than that if you also qualify for the foreign housing exclusion. In addition, you can exclude or deduct certain foreign housing amounts, and you may be entitled to exclude from income the value of meals and lodging provided to you by your employers. The limit on the amount of income you can exclude is adjusted for inflation annually. I never really quite remember what this number is because it changes every year, but for 2012, it's $95,100. So what are the requirements for claiming the exclusion? To claim the foreign earned income exclusion, the foreign housing exclusion, or the foreign housing deduction, you must meet all of the following requirements. Number one, your tax home must be in a foreign country. You must have foreign earned income. That means wages or self-employment income. And you must be either a U.S. citizen who is a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year, or you must be a U.S. resident alien who is a citizen or national of a country with which the United States has an income tax treaty in effect and who is a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire year, or you must be a U.S. citizen or resident alien who is physically present in a foreign country or countries for at least 330 full days during 12 consecutive months. Note, however, and this is kind of a bummer, if you happen to be a U.S. government employee, you are not allowed to exclude income on Form 2555. Form 2555 does not apply to any person who is an employee of the U.S. government, and that includes military personnel. That 330-day rule is pretty much set in stone. There's no deviation from it. The only exception is if you are required to leave a foreign country because of war, civil unrest, or similar adverse conditions in that country, the 330-day rule can be waived. But if you have to leave the foreign country because you were fired or lost employment or there was a change in health, you will not meet the 330-day rule. Who can claim the exclusion? To claim the exclusion, You can qualify to exclude up to $95,100 if you pass either the bona fide residence test or the physical presence test. So we're going to look at the bona fide residence test first. To meet the bona fide residence test, you must establish a bona fide residence in the foreign country. You must show the IRS that you have been a bona fide resident of the foreign country for an uninterrupted period that includes an entire tax year. So if in 2011 you moved to, let's just make up England. You moved to England in 2011, and you arrive in England in August 2011. Well, you're probably not going to meet the bona fide resident test for 2011 because you weren't in England for the entire year. But if you continue to live in England for all of 2012, and it's foreseeable that you're going to be there for the future because you've made that your home, well, now you're going to pass that bona fide resident test for 2012. The importance of the bona fide residence test is it means that you can leave England and come to the United States and spend more than 35 days in the United States during the year, and you're not going to lose your ability to file the 2555 and claim that exclusion. But if you don't meet the bona fide residence test, then you do need to meet the physical presence test, and it's a little bit more strict in terms of you have to count the number of days. You meet the physical presence test if you are physically present in a foreign country or countries for 330 days in a period of 12 consecutive months. But the 12 consecutive months don't need to be in the same year. So let's go back to that English person, the person who moves to England. They arrive in England in April of 2011. Well, are they allowed to claim the foreign earned income exclusion for 2011? The answer is yes, if they reside in England for a 330-day period in that first 12 months. So if the first 12 months starts in April, then it would end the following year, 2012, at the end of March. And in that time frame, they have to have been physically outside of the United States for a minimum of 330 out of 365 days. So it is possible to meet that requirement even if you weren't gone the entire year. But the IRS says you only meet that requirement when you've actually been there the required number of days. So conversely, let's just say you moved to England in August of 2011. You won't have met that 330-day period of time until August of 2012, and so you're going to have to file an extension to show that you've met the required 330 out of 365 days, and once you've lived in England the required amount of time and you meet that requirement, then you can file your U.S. tax return and claim the foreign earned income exclusion. So here is a table. It comes straight out of the IRS instructions on 2555. It's actually publication 54 that you will see this figure in it. And in their example, they say if you arrive in the foreign country, you can look at the 12-month period that begins January of 2011 through December of 2011, but you could also meet the 330 days by being there from August of 2011 through August of 2012. They're looking at 330 days, and they need not be in the same year. They can straddle 2 years. So there is also a flow chart that is provided in IRS Publication 54. It's a nice way to summarize or to establish whether or not your tax client meets the rules or conditions for being able to claim the exclusion. And in the table, you start with the question, did you have foreign earned income, that is wages or self-employment? Is your tax home in the foreign country? That means are you living in that country as the main place that you're earning your living. IRS establishes tax home as the primary central point at which you earn your living, and you have to show that your tax home is in that foreign country. If you're able to show that, then the next question is, are you a U.S. citizen? And if you are, the next question is, were you a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year? Well, if 2012 was the year that you moved to the foreign country, you would not be able to answer yes to the bona fide residence test. So you would answer no to that test, and then you'd move down to the next box that says, were you physically present in a foreign country or countries for at least 330 full days during any period of 12 consecutive months? And if you're able to answer yes to this box or yes to that box, then you are allowed to claim the foreign earned income exclusion. Now, I figured you'd probably want to have an illustration. In our illustration, we have a character named Aussie Sunshine, who is a U.S. citizen that moved to Perth, Australia on June 30th, 2012 to begin work at Down Under University as a professor. he had $50,000 of income that was earned inside the United States, and he had another $50,000 of income that he earned after he arrived in Australia. Since Ozzy was outside of the United States for less than a full year, he is going to be required to prorate his exclusion based on the number of days he resided outside of the United States. And you're going to have to calculate his earned income exclusion as follows. Well, one of the things we have to remember as well is that he will not meet that 330-day rule until the end of May 2013. So he's not going to be able to file his return and claim this exclusion before the end of May, but once the end of May comes, then he can file and show he meets the 330-day rule. So he begins by taking the maximum amount of income that can be excluded, which is $95,100, and then he determines the percentage of the exclusion that he is allowed to claim. He's going to look at the days of physical presence outside of the United States, and if you add those up just by finger counting, which is what I do, you end up with 184 days outside of the United States, out of 366 days. And 2012 was a leap year. That's why we have 366 days. That means he was outside of the United States for 50.3% of the year. So you're going to take $95,100 and multiply that by 50.3%. And the amount of wage he will be allowed to exclude is $47,835. That's less than he earned. He earned $50,000 in Australia. He's only allowed to exclude $47,835. But he will be able to enter $47,835 as a negative number on his 1040. So on the 1040 on line 7, we report his total wages that he earned for the year. There was $50,000 inside of the United States and $50,000 outside of the United States. He enters $100,000 on line 7. Then he enters on the space next to line 7, FEC 50,000. That means he's reporting to the IRS that foreign earned compensation for the year totaled $50,000, and it's being included on line 7. He then goes down to line 21 and enters form 2555, negative $47,835, and he carries that to line 21. He subtracts line 21 from line 7, and he gets his adjusted gross income for the year. He also needs to attach Form 2555 to his return, and in this case I've given you 2555EZ. Information that needs to be included on here is, does he meet the bona fide residence test? The answer is no. But does he meet the physical presence test? The answer is yes. He's going to meet that requirement in 2013, provided he waits late enough into 2013. So when he files the form, he is going to indicate the date that his tax home was established in Australia, and that was June 30th. Part 3 of the form asks for the physical days that he was present inside the United States, and you can see I've left it blank. The reason that it's blank is you only enter dates traveled to the United States after the period of United States residency ends. So for the first half of the year that Ozzy lived in the United States, you leave the form blank because he had not yet established a tax home outside of the United States. But once his tax home has been established outside of the United States, if he then travels to the United States, the IRS wants to know when he traveled to the U.S. And then the final part, in Part 4, we are figuring the amount of the exclusion. $95,100 is pre-filled in on the form by the IRS already. We enter the number of days inside the qualifying period. We enter .503 because that is the percentage of income that can be excluded from the $95,100, and we get $47,835. Now the final thing you might be wondering is, well, what about that extra income, that $2,165 of income that is now being taxed by both Australia and the United States? It is possible for Ozzy to claim a foreign tax credit for any income that is being taxed by the foreign country but is too much to be excluded from his income on 2555. But the foreign tax credit cannot be claimed against any income that is excluded on Form 2555. And the foreign tax credit is a topic that I'm going to cover in our upcoming class called Federal Credits for Individuals. And in that particular course, I'm going to show how Form 1116 is used to claim the foreign tax credit and what you would do if your client also simultaneously qualifies for the foreign earned income exclusion, how you would figure the foreign income exclusion and how you would claim the foreign tax credit on the same tax return. We have a good illustration of that coming up in one of our upcoming classes. Taxable and non-taxable income, the final topic of the day. All of the items you see listed on this table are forms of income that is either not taxable or is taxable. Under non-taxable income, benefits that you should be aware of that are not taxable are welfare, food stamps, workers' compensation, disaster relief grants made under the Disaster Relief Act, cash rebate on an item you buy from a dealer or a manufacturer, mortgage assistance payments, campaign contributions that are spent for campaign purposes, casualty insurance and other reimbursements, child support, court awards and damages for personal injury or distress related to such injury are not taxable. Energy conservation subsidies paid by utilities for the purchase or installation of an energy conservation device in a dwelling are not taxable. Foster care payments that you receive for the care of children under age 19 that are placed with you by a government agency or a tax-exempt child placement agency also are not taxable. Difficulty of care payments you receive for the care of 5 or fewer individuals age 19 or older are not taxable. Gifts and inheritances generally are not taxable. Indian fishing rights in place before 3/17 of 88 are not taxable. And I actually have a client who has Indian fishing income every year, and he does not have to pay tax on it. Job interview expenses paid by a prospective employer. Interest on a qualified savings bond you redeem to pay for qualified higher education expenses, and we talked about that in today's class. Sale of personal property you sell at a loss, the loss is not deductible. Scholarship and fellowships used to pay for tuition fees and books are not taxable. VA payments paid by the Department of Veterans Affairs are not taxable, but we're talking about the disability benefit, not an actual retirement pension that a veteran is receiving from the government. Utility rebates that reduce the purchase price of electricity furnished to you or give you a non-refundable credit against the purchase price of electricity are not taxable. And finally, money that you borrow from others but you're required to repay is not taxable. But all of the items in this column are fully taxable, and they include Alaska permanent dividends. These are reported on the unemployment line if you're filing 1040-EZ or 1040-A. They're reportable on the other income line if you're filing the long form 1040. Activity not-for-profit such as hobby income is taxable. Alimony is taxable. Bribes are taxable, as are court awards and damages for any type of award or damage that is not due to personal injury or distress from personal injury. Court awards and damages that are taxable include lost wages or profits, punitive damages, settlement of pension rights, patent or copyright infringement, breach of contract, back pay or damages relating to emotional distress from civil rights violations are all fully taxable. Credit card insurance payments are taxable. Jury pay, all $10 you got for those 3 days you sat on jury, is taxable. Estate and trust income distributed or required to be distributed to you is taxable, and the amount that is taxable will be shown on Schedule K1 from the 1041. Rents received for use of personal property, net business income after expenses, fees for services you perform as a corporate director, executor, or administrator of an estate, notary public, or election precinct official are taxable. Foster care payments you receive from a government or tax-exempt child placement agency if you care for more than 5 individuals who are age 19 or older. Difficulty of care payments that you receive for the care of more than 10 qualified foster individuals under age 19 or more than 5 qualified individuals age 19 or older. Payments received for maintaining space in your home for the care of foster individuals are taxable. Gambling winnings, lotteries, and raffles are taxable. Illegally gotten income is taxable. Prizes, awards, and free tours are taxable. Sale of personal property you sell at a profit is reportable on Schedule D. Scholarships used to pay for room and board are taxable. Strike and lockout benefits are taxable. And canceled debt other than by gift or bequest is taxable. Now, I wanted to point out some of the things on this column under what's taxable. One of the most common things that I hear that absolutely boggles my mind is when I have a client come and sit in front of me who says, well, my preparer last year told me since I didn't get an income statement for this gambling winnings that I had, I don't have to report that on my tax return as income. Or I received this particular payment from someone, but it wasn't reported on a tax document, so they said I don't have to bother reporting it. Well, that's just flat out not true. Tax law determines what's taxable, and the fact that a particular income item was not reported to the government doesn't mean it's not taxable. So it's always a little bit uncomfortable for me when I have a client who tells me that their tax preparer who they were using before me always told them they didn't have to report a particular type of income, but now I'm telling them that they do have to report it. And I do know that in the past, I think it was the General Accounting Office actually went out and sent out silent or secret shoppers to get their tax returns prepared. And the number of preparers who prepared tax returns incorrectly was pretty much 100%. And some of the reasons that the tax preparers were getting the returns wrong was by telling their shopping clients that particular incomes were not taxable when in fact they were.
Please pause the lecture video and complete this session's classwork. Enter your answers into the LMS when you have finished. Then resume the lecture for the classwork review. Let's take a look at classwork 1. What we have here is a list of 15 items. We've asked you to decide whether they are subject to federal income tax or not. So let's take a look at the list. A, state lotto winnings. Those are definitely taxable at the federal level. We have bribes. Those are also taxable. Income from illegal activities. This is also taxable. D, child support. Child support is not taxable. This is something that comes up a lot, and it is not a deduction for the non-custodial parent that pays the child support, and it's not reportable for the custodial parent that receives the child support. So even though you're paying child support for that child, you are not able to take a deduction for that. E, spousal support under a divorce decree. This is taxable. The spousal support is an adjustment to income for the spouse that's paying the support, and it's reportable as income to the spouse that's receiving it. F, prize of a free trip to Hawaii. Well, if you're lucky enough to get this, guess what? They're going to tax you on that also. That's going to appear on line 21, other income, of the federal 1040. Veterans benefits. Veterans benefits are not taxable. Now, you want to make sure that you don't confuse this with veterans pension. Veterans benefits are usually paid for a disability, whereas a pension from being a vet is fully taxable as pension income. Tips not reported to your employer. Well, we've learned by doing some exercises that even though tips are not reported to the employer, they're still fully reportable on line 7 as income, and sometimes you'll have to fill out the 4137 and pay Medicare and Social Security tax also. I, a tip of less than $10. Well, people sometimes get confused on this and they're thinking, well, it's less than the $20. You don't have to report it to your employer. But we have already learned in session 3 that a tip, no matter what size, is reportable income on the federal tax return. Gross hobby income is reportable income and taxable. Interest on a federal bond is taxable on the federal return. L, interest on a state bond, that is not taxable on the federal return. Meals supplied by and for the convenience of your employer are not taxable. Severance pay, just like being paid your wages, it is taxable income. And then finally, O, canceled debt that is not a gift is taxable income also. Okay, classwork 2. We tell you that David Lerner is single and lives with his son James Lerner. This address in Portland, Oregon. James is a senior in high school. David's ex-wife pays him $400 a month spousal support and $400 a month child support for James. David pays more than half the cost of maintaining his household. David was unemployed from January through March and received a 1099-G. Complete his federal tax return. So you can see here, this is his 1099-G. His unemployment compensation is reported in box 1 of the 1099-G. And if we go down here on the next page, you'll see his W-2, and you'll see that in box 1, he's got wages of $37,050, federal income tax withheld of $3,500, and now we will take a look at what comes out for his federal tax return. So David kept up his home for his son, so we know that he's going to qualify for the head of household filing status. James, going from his date of birth in 1995, so 2012 minus 1995 gives us age 17, is too old to qualify for the child tax credit. So David will get a dependency exemption for him. He has a qualifying child for head of household filing status, and he has a qualifying child for the dependency exemption, but he's not going to qualify him for the child tax credit. So David's going to report $37,050 of wage income on line 7. He's also going to report $4,800 in alimony received from his ex-wife on 1040 line 11. And the child support that he receives is not taxable, so it is not reported on the tax return. David received $4,375 in unemployment compensation, so he will enter that on line 19 of the 1040. He's also eligible for the head of household filing status, so he gets a standard deduction of $8,700 on line 40, and he's going to claim 2 exemptions and enter $7,600 on line 1040, line 42. So let's go down and take a look at the completed tax return. We've got David's information here, address, social security number. He is going to mark the box for head of household. He's going to mark the box for himself on line 6A. He's going to go ahead and report his dependent James under exemptions. On line C, under dependents, you put in the child's first and last name, their social security number, and what their relationship is to you. Since he is not under the age of 17, he doesn't qualify for the child tax credit, so we do not mark the box in column 4. But we do put a 1 here for his exemption. Total them up. The total exemptions now on line 60 are 2. Line 7, from his W-2, we report the wages of $37,050. This is the alimony that he received. He received $400 a month, so 400 times 12 is $4,800. Move down to line 19. This is where we report his unemployment compensation that we found on the 1099G, box 1. Total all the income items up. We have 20 on line 22, $46,225. David does not have any adjustments to income, so we go ahead and bring down the $46,225. Move over to page 2 of the 1040, where we will go ahead and write that number once again on line 38. So standard deduction, go over here, and this time we're looking for head of household. Head of household in 2012, their standard deduction is $8,700, so we bring that over here to line 40. We subtract that from the adjusted gross income on line 38 and get $37,525. We already know that on the front page of the 1040, we had 2 exemptions, one for David and one for his son James. So we multiply 2 times $3,800, line 42, $7,600. Subtract that from line 41, we have $29,925. Go ahead and look at Pub 17, the tax tables. We'll look under head of household for the income level of $29,925, and you should have come up with tax to put on line 44 of $3,869. Okay, let's take a look at classwork 3. This might have been a little bit more challenging than the previous 2. We have told you what forms you're going to need to fill out this tax return. Form 1040, Schedule B, Schedule E, page 2, Form 4137, and Form 4562. So we have Jerry McGuire, Date of birth, 1960. He's a server. He pays his ex-wife, Dorothy Boyd, child support and alimony. According to the divorce decree, Jerry must pay Dorothy $400 a month spousal support and $800 a month child support. During the year, Jerry made payments to Dorothy totaling $13,200. At the end of the year, this puts Jerry behind on support payments and still owed Dorothy an additional $1,200. Jerry was lucky this year. He won a free trip to Mexico valued at $3,500. He also won $600 in the Washington State Lottery. In addition to receiving a 1099 INT from Ducks Bank and a 1099 DIV from Cleats Inc., Jerry had investment income from the following: Port of Portland bond, $1,000, Port of Seattle bond, $500. Jerry received quite a few large tips during the year and did not report all of them to his employer. He cannot verify nor dispute the allocation in Box 8 of his W-2. Jerry also received a K-1 showing his share of income from Gridirons Inc., an S corporation in which he is an active participant. Jerry's W-2 and K-1 are attached. Prepare his federal tax return. So let's go ahead and take a look at what Jerry's got going here. W-2 got $25,000 in Box 1. That includes $10,000 of Social Security tips. Box 8 is showing $5,000 of allocated tips. And then Box 2, he had federal income tax withheld of $3,500. Move down and take a look at his interest income. From Ducks Bank, we've got interest income in Box 1 of $1,300. Box 3, U.S. Savings Bond interest of $250. Over here, we've got his 1099 DIV. It's got $500 of ordinary dividends in Box 1A. Here's Jerry's K-1 from Gridirons Inc. It shows that Jerry got $1,600 in ordinary business income, $1,000 in interest income for Jerry, and they also have marked out in Box 11, Section 179 deduction of $400. Let's see what the answer key has to say about Jerry's return. Under his wages, Jerry's W-2 shows that he received $25,000 of wages and tips in Box 1. However, he has also been allocated $5,000 of tips in Box 8. Since Jerry cannot dispute the allocation of tips, he is going to have to fill out Form 4137 to report the Medicare and Social Security on the allocated tip. That $25,000 is going to go on line 7 of the 1040. Let's take a look at Jerry's tax return. Let's start with the forms that you would have to fill out. Okay, Jerry's 1040. Got his personal information in here, name, address, Social Security number. He is going to be filing single. He has no dependents that qualify him for head of household filing status, and he is no longer married. So the only filing status available to Jerry is single. On line 6A, he's going to mark the box for himself, put a 1 on the line, and then down here on 6D, 1. Line 7, wages and tips. We already talked about that he's got $25,000 on his W-2, but let's take a look here. So we know he's got $25,000 in wages and tips that were all reported, and then he's going to have the $5,000 that we're going to have to add and report as income for Jerry. Line 8A, $2,550. Well, let's see where that came from. Jerry has $1,000 Port of Portland bond and $500 Port of Seattle bond. We saw on here that Jerry had $1,300 in Box 1 and $250 in Box 3. Both of those are taxable items, but that only adds up to $1,550. Let's see where that extra $1,000 is coming from. And how we'll look at that is on Schedule B. Since Jerry has more than $1,500 in interest income, he must fill out a Schedule B. So we've got Ducks Bank here, but we also have Gridiron Zinc. Ducks Bank here from his 1099 INT reporting $1,550, but we also have Gridiron's Inc., which is reporting $1,000 in interest income. So if we go back down here and take a look at that K1, that's where that additional $1,000 is coming from. It's from line 4 on the K1. So we subtotal that, 2,550, carry it down to line 2, and carry it down to line 4. Since we're filling out Schedule B, we're also going to go ahead and drop Jerry's dividend income on there, $500, subtotal it, and then drop it down here on line 6. And that's going to carry over to the 1040. Let's take a look at that. Page 1, line 8A, the $2,550 is carrying over for the interest. The $500 is carrying over for the dividends. And then we told you that he has Port of Portland bond of $1,000 and a Port of Seattle bond of $500. That's non-taxable at the federal level, so we're going to report it on line 8B. We've put the $1,500. See here, line 17, we have $1,200. Let's see where that came from, making you figure out the K1 and giving you not only ordinary income on the K1, but putting in this Section 179 deduction. And I already know in my head that Section 179 $400 amount is going to be a subtraction to ordinary income, and that's how we arrive at the $1,200. But let's go see how we actually did that. Let's take a look at the 4562 first. So what you need the 4562 for is to make sure that Section 179 deduction is not going to phase out for Jerry and that he can go ahead and claim that on his 1040. So you go through Part 1 here. You've got the maximum amount you receive from the instructions. There's the threshold amount. He doesn't have any reduction in limitation, so his Section 179 dollar limitation for the year is $500,000. That's certainly more than what the $400 is reporting from the Gridiron's K1. You should have put that amount from line 11 from the K1 here on line 6 on the 4562 and written something similar to this from K1 Gridiron Zinc. The cost is $400. The elected cost, that means the amount we elect to issue as a Section 179 deduction, $400. The tentative deduction is $400. You do the smaller of line 5 or line 8. Line 8 is the smaller, so that's what goes on line 9. There's no carryover that we've told you about. If you'd followed the instructions to get the limitation, it would have been $32,600. Jerry's $400 is well below that, so his allowable Section 179 deduction is the $400. And that is what is going to carry over. Schedule E, page 2. Schedule E, page 2, among other things, is used to report K1s. Go ahead and let the government know whom is giving the K1 to the taxpayer. So we go ahead and put Jerry's name on the top, Social Security number over here, and on line 28A we put Gridiron. We told you Gridiron Zinc is an S corporation, so we put an S in column B. It's not a foreign. We didn't tell you it was a foreign partnership, so no check and see. Put the employer identification number that we get over here on the K1 right there. Since we told you that Jerry is an active partner, so we're going to look at between passive and non-passive income. Since Jerry is an active partner, it's non-passive income. We go ahead and list that Section 179 deduction right there, $400. We list the total income from the K1, $1,600. Bring them down, line 30, add all the income. Line 31 is the deductions. $1,600 minus $400, and that's where we end up with the $1,200. And we're told to include it on line 41 below. Go down to line 41, put it in there, and we'll go ahead and it says enter it on Form 1040, line 17. So we'll go back up to the 1040, and we'll see that's, of course, where we came up with the $1,200 there. Now, line 21, income. Jerry won the lottery, and he also won a prize. We've learned from our lecture that both of those items fall underneath other income on the 1040. But anytime you have more than one item, the IRS likes you to do a statement and list out where that total amount is coming from. And your statement should have the name and the total amounts. Let's go down and see what we've done for the statement. Right here, Jerry Maguire, supporting statement. You always have a title line saying what the statement is calling out. For this statement, it's Form 1040, line 21, other income. We have a description. He had a prize of $3,500, and he had gambling winnings of $600. Total, $4,100. And if we go back up to the 1040, we'll see that's what's on line 21, $4,100. So we go ahead and we add up all the income items for Jerry Maguire, the $30,000, the $2,550, the $500, the $1,200, the $4,100, and we end up with total income on line 22 of $38,350. Now let's go to adjustments. So far we haven't had anything in the adjustments area when you've been doing a tax return for class, so this is the first time. Jerry did pay alimony, and we need to fill out the amount that he paid, which is $3,600. But let's go back up here to the description. Let's figure out how he came up with that amount. He paid Dorothy $13,200 during the year. Of that, $400 a month is supposed to be spousal, and $800 a month should be child support. Well, as we've learned in lecture, child support always comes first before spousal payments. So if you're behind, the child support gets paid first. So we have 12 times 8 totals $9,600. That's the whole amount of child support for the year. That's what it's supposed to be. We subtract that from the total amount that Jerry actually paid to Dorothy, which is $13,200, and we end up with $3,600 that'll go towards alimony. Now, if you see on line 31A, we put the $3,600, but then on B, 31B, it's also asking for the recipient's Social Security number. Now, why do you think they ask for that? Well, they're asking for it because they want to be able to track it on the recipient's end and make sure that it's being reported as income. We add all the lines up in the adjustments area. On line 36, we put the total of $3,600. We subtract that from the income, and we end up with $34,750. Let's move over to the second page of the 1040. We'll go ahead and once again put that number from 37 on line 38. We've got adjusted gross income of $34,750. We're looking for the standard deduction. This time we're looking for single standard deduction. For 2012, that's $5,950, so that's what we put on line 40. Subtract that from line 38, we have $28,800. Since Jerry is single, no dependents, he only has the one exemption of $3,800. Subtract that, and we end up on line 43 with $25,000 of taxable income. Go to Pub 17 tax tables, look for the single row, and at the $25,000 income level, there's $3,319 in tax. Bring it down to line 55. We'll also have to do a 4137 for Jerry to report that $5,000 in allocated tips. For Medicare and Social Security, we fill out 4137 and come up with a total of $283. Add both of those together on line 61. Total tax for Jerry for the year is $3,602. He only had $3,500 withheld on his check, so Jerry is going to owe the federal government $102 on this year's return. Well, that's the conclusion of the classwork. Well, this is the end of Classwork 3, Classwork Review. Go ahead and follow the instructions to complete this session coming up on the screen in a few moments, and we will see you in Session 5. Goodbye. To complete this session, number 1, take the password test in the LMS. Number 2, complete the homework assignment and enter your answers into the LMS. And 3, complete the quiz and enter your answers into the LMS.
Password number 3 is now showing on the screen in front of you. Please write it down. Password number 3 is Denali, D-E-N-A-L-I. Password number 3 is Denali. Please write it down.